Good afternoon, and welcome to our 2025 Year-End Financial Checklist webinar. My name is Brian Taylor, Wealth Director for our Princeton market, and I'm joined by fellow Wealth Director David Navarro and a Wealth Strategist from our team, John Walters. Today, the three of us are going to help you take stock of where you are, where you're headed, and the key year-end steps that can set you up for a strong start to the year ahead. In the spirit of the holidays, think of today as your financial version of Santa Claus checking his list twice. But instead of figuring out who's been naughty or nice, we're going to help you make sure your retirement savings, taxes, investments, and cash flow strategies are all right where they need to be before the calendar turns. We all know the last few months of the year can feel kind of hectic between holiday plans, family gatherings, shopping for gifts, and closing out those projects at work. But setting aside a little time now to review your financial picture can really make a meaningful difference. Here are some of the things we're going to cover today. We're going to talk first about tax and investment strategies to consider before year end, estate and gifting opportunities that can really make an impact, and planning ideas for 2026 and beyond, including a look ahead at potential tax law changes. We'll keep this concise, actionable, and wrap it up with a short Q&A at the end. So again, thank you for spending a part of your busy day with us. We hope you leave today feeling more confident and better equipped to finish the year strong. But before we begin, let's take care of a couple of housekeeping items. First, please feel free to use the Q&A button at the top of the screen to submit questions at any time throughout the webinar. We'll do our best to address your questions during that Q&A session I referenced later in the webinar. Secondly, this session is being recorded, and we'll send you a link to the recording along with additional resources from the webinar, so don't feel like you have to take exhaustive notes. And lastly, please note, today's webinar should not be construed as legal, tax, or financial advice. Please consult your personal advisor to determine how this information may apply to your own situation. With that said, let's dive into how you can finish strong in 2025 and set the stage for success in 2026 and beyond. Let's kick it off with tax planning. John, as I was planning for our webinar today, I was reminded of something I candidly had forgotten. The Roth IRA, one of today's most popular tax advantage accounts, was created in 1997 and is named after its sponsor, Senator William Roth, who hailed from right down the road here in Delaware. So John, besides the Roth IRA, what other tax planning strategies should we consider into year end?
Thanks, Brian. Yeah, it's very much when we think of the calendar year, it's Roth o'clock. We're thinking of things that like a Roth conversion, tax loss harvesting, qualified charitable deductions, Roth conversions, all of those types of things. But when considering Roth and other opportunities, it all starts with your income. Now that it's the end of the year, we can develop a pretty good accounting of your various income sources, and we have a pretty large audience today. So this can include things like your salary, bonuses, business distributions, commissions, interest, capital gains distributions, restricted stock units, inheritance, IRA distributions. I mean, the list goes on. And now that most of that is out of the way, this really opens up our playbook and highlights, Roth as being one of these great year-end strategies that we can now implement. And we know that some of that stuff is out of the way. So, once we've accounted for income, we consider your best options to optimize your tax bracket. We want to think about exactly where you are so that we can set you up for success this year and in the future. So if you're on the threshold of a bracket, you may want to consider strategies to defer income or accelerate deductions. We want to manage your capital gains and losses to keep you in a lower tax bracket. And so in 2025, what we have to be really kind of keenly aware of are these big jumps. So you'll see between the tax brackets of 12%, we jump up to 22%. And from 24%, we jump up to 32%. So, really when we're trying to understand, where you are versus where you want to be, we want to be keenly aware of that. And we also want to, remember that throughout life, things change. So if you've had a change from single or now you're married filing jointly or married filing separately, we want to be aware of that so that we can really make sure that we're on top of all that stuff. If and then it comes to, some of these kind of longer views of our life. So for instance, if you're in a higher tax bracket and you presume you'll be in a lower one in the future, so perhaps you're getting ready for retirement. In retirement, you don't anticipate any big, kind of pensions continuing things. We want to look for places to defer that income. That allows us to maximize our pre-tax contributions. This can present an opportunity to maximize your 401k if you have a SEP IRA, or take advantage of your health savings account. Remember, your health savings account in a lot of cases can be this kind of ace up your sleeve. And if you have that available, that can be, kind of an extra gear in retirement. There may still be a window for, larger contributions. And don't forget that if you have any tax loss carry forward, so let's say, for instance, you had a loss a couple of years ago, you can carry them forward. And, there might be an opportunity now, or we might want to save that for the future. And then if you're in a lower tax bracket and you think the taxes could be higher in the future, that might present an opportunity to consider Roth. So let's say, for instance, as when we look at, thousands and thousands of clients, and we look at the way that their cash flow goes over time, there can be kind of a drop before your required minimum distributions come in. And there might be, maybe you might find yourself in a lower tax bracket for a few years. This could present a great opportunity to consider a Roth 401k, larger contributions. You may want to consider a Roth conversion. And additionally, if you're over 59 and a half, we may want to consider small regular distributions that can save you money in the future. So there's not just one playbook one play like you have to do a Roth conversion. Sometimes when we're trying to stabilize your tax bracket, taking some smaller distributions can really go a long way. So finally, if you're charitably inclined, if you've attended some of our earlier, webinars this year, you'd know that a donor advised fund, this is a very good year to end 2025 with, utilizing a donor advised fund before, we're going to have a change in the next tax year. So you may want to consider highly appreciated securities from your taxable brokerage account. Here at Bryn Mawr Trust and Bryn Mawr Trust Advisors, we can create DAFs for you. And if you're over 70 and a half years old, you can do what's called a qualified charitable distribution. And so qualified charitable distributions go directly from your IRA right to the charity of your choice, and they make those IRA distributions fully deductible. So, if you have a charity in mind, there's lots of ways to utilize that.
Yeah, and the QCDs have really become a really powerful tool lately, and we've seen a lot of clients use them. So, really good call outs there. But John, taxes are really only one part of the story, right? I read such, especially right here at year end, obviously we've got to think about taxes, but there's a lot of other things we want to think about. And I read somewhere that roughly 2/3 of American adults do not have a will. Yet over half say that they really care deeply about how their assets are distributed. Additionally, many of today's estate plans, for those that already have one in place, often don't include things like social media accounts, cryptocurrency, and cloud storage. These are really items that didn't even exist in estate law, as recently as a few decades ago. So, John, in today's world, why is it so important to create or review an estate plan, and why is year-end a great time to do it? Maybe you can walk us through some estate planning ideas, and maybe you can expand a little bit more on some charitable giving practices.
Yeah, absolutely. And I'm going to start with the last part of your question first. This is the end of the year. We have the holidays, and it can be a great opportunity to, talk to your family about what might be out there, and how you can, share your experience and how you may want them to consider moving forward if something were to happen in the future, or just to share everything that you may have. So to kind of continue with that, and thinking about gifting, gifts up to the annual exclusion for 2025 are $19,000 per donee, and they're gift tax free, which means you don't have to file a Form 709. And that means that if you are a married couple and you're gifting to an individual, you could gift up to $38,000. And if you are gifting as a married couple to a married couple, you could gift up to $76,000. So, if we're thinking about trying to reduce your estate and, and try to maybe do that during your lifetime, that can be, a great option that can allow you to, move those funds. And it can be kind of a little bit of a test too, for if you think that there's a larger estate distribution that might happen in the future. So it can be a learning experience for the recipient. And, that kind of brings me back to, now that it's the end of the year, when we reflect on all the changes that we have, and all the changes that happened in 2025, we want to remember that that's a rationale for reviewing the estate plan. When we reflect on the births and deaths, the marriages, the divorces, the new homes, the sold properties, and, all of the other events, whether you're going through a life change, or a, marital shift or anything like that, speak to your advisor, because we've got lots of ideas to help you achieve your goals. And all of those items, if you properly communicate, they can have, really more positive outcomes. And as your family gets older, you want to coordinate those efforts through, legacy planning. Next year, just like increases in the standard deductions and SALT deductions, you'll see federal estate and gift tax exemptions increase to $15 million per person and $30 million for couples.
Yeah, there's a lot for people to do as we get closer to the year end here. It's hard to believe we're already past the halfway point so far. So, well, thanks, John. We're going to come back to you in a few minutes, but maybe we should shift gears a little bit, and let's get David in the loop here, and let's talk about our investment review and portfolio positioning. As we close out 2025 and look towards the year ahead, David, I'll give you a fun fact that sets the stage. I think analysts are estimating that nearly 1/3 of global equity gains in 2026 could come from industries that just really didn't exist even a decade ago. Whether it be AI infrastructure or next-gen energy storage, it's really quite remarkable. I think it's a great reminder for us that markets don't stand still, and neither should portfolios. So, David, let's take a look at how 2025 wrapped up, what drove performance across asset classes, and what themes resonate as we step into the new year.
Yeah, thank you, Brian, and good afternoon, everyone. I'm glad to be here to discuss the markets. And I walked through a couple of key investment checklist items to address before year end, before turning the conversation to 2026 and beyond. But you basically said it, Brian. This year has been shaped by dramatic global events and powerful investment themes. The year began with uncertainty and volatility, most notably sparked by significant shifts in trade policies. Investor focus rapidly pivoted to the transformative acceleration in AI investment and the aggressive build out of data center infrastructure to meet soaring demand for compute power. Now, this pivot supported strong performance across multiple asset classes and regions, with international markets outperforming the U.S. overall, primarily due to U.S. dollar depreciation in the first part of this year. At the same time, though, U.S. sectors such as technology, communication services, and industrials also produced favorable results, with industrials emerging as a beneficiary of the data center infrastructure theme I just mentioned. However, though, broadly speaking, equity valuations remain a key concern for analysts, with the S&P 500 trading around 22.5 times on a next 12 months price to earnings basis, well above its 25-year historical average. Now, while elevated valuations may be more indicative of concentration risk that we see in the markets at this current juncture, it is important to remember that valuations are not very effective at predicting short-term market movements. However, they do highlight the need for durable earnings growth to sustain the rally that we've seen and support further upside, which is why investors should really closely monitor earnings trends, net profit margins, and sector dynamics. And then on the flip side, fixed income, broadly speaking, bonds have delivered a really strong rebound as the Federal Reserve cut rates by 75 basis points in total this year, supporting bond prices while still maintaining attractive yield opportunities for investors seeking balance and income within portfolios. In addition, tighter credit spreads and improved total return profiles across many segments of the bond market have helped restore fixed income's role as both a diversifier and a more reliable source of income. And then lastly, again, you mentioned a little bit ago, obviously you read any headlines, cryptocurrencies such as Bitcoin and Ethereum, they delivered extraordinary gains in 2023 and 2024, driving market capitalization above $4 trillion by the start of this year. This year, returns have been more subdued for the asset class, but the introduction of stronger regulatory frameworks and formal policy recognition advanced the asset class into a more mainstream framework for investors. So that's a little review as far as this past year, 2025. But when it comes to items to check before the end of the year, it's really important for an investor to remember, I would say, a couple of core practices that apply every year. And the first is managing portfolio drift, which is simply how far your current mix of stocks and bonds have moved away from their long-term target allocation. So year-end is really an ideal time to assess whether an investor's mix still aligns with their goals, risk tolerance, and time horizon. Systematic rebalancing brings discipline, helping investors avoid emotional mistakes and chase fewer short-term trends, while a constant mix approach naturally buys low and sells high as it restores allocations to target. This can mean adding to equities after down years or trimming after strong gains, like we've seen in 2025, to keep risk and balance in check. Now, maintaining long-term asset allocations typically involves shifting assets between classes, but there are two additional mechanisms investors can use for rebalancing portfolios. So first, really simply, investors with idle cash and no immediate spending needs can deploy their liquidity into the portfolio to maintain discipline and alignment. Additionally, if the portfolio is at its target allocation and cash remains, it can be invested in short-duration bond funds, treasury ladders, or other high-quality fixed income vehicles, which helps capture current yields. And then second, for those required to take distributions from IRAs, those required minimum distributions, these mandatory withdrawals present the useful opportunity to rebalance portfolios by meeting RMDs through the sale of overweighted assets. Investors can realign their allocation in a tax-efficient manner rather than generating additional transactions purely for rebalancing purposes. Now, I do want to take a step back and just stress that although I did mention end of year as a prime opportunity to rebalance a portfolio, those rebalancing decisions are never made in a vacuum. And with year end approaching, the natural question from investors and clients is often, can we wait and rebalance in 2026, especially when an investor will incur capital gains? Now, in many years, the answer can be yes, but recent history is a reminder that markets do not always cooperate. So for example, at the end of 2021, going into 2022, the market actually peaked right at the start of the year in 2022, with January 2nd, the first trading day of the year, actually being high for that year, sold off close to about 10% into late January. And despite some rebounds in April and August of that year, the market really did not bottom until 2021. Essentially, investors possibly missing a prime opportunity to rebalance their portfolios late in 2021. So I think that example kind of raises the issue of that tax tail wagging the portfolio dog. But more importantly, we want to stress that it is critical to remember there's always a trade-off between portfolio rebalancing and tax impact, which is why every investor should have a thoughtful conversation with their advisor about capital gains budgets and a clear plan tailored to their specific situation. Moving to the second checklist item that should be practiced every year is tax loss harvesting. John mentioned it before. Tax loss harvesting is the strategy of selling investments at a loss to offset realized capital gains. The proceeds are typically reinvested in similar but not substantially identical investments to maintain market exposure while realizing the tax benefit. Proactive tax loss harvesting becomes especially important in years when mutual funds are expected to distribute sizable capital gains, as realized losses can help offset those expected distributions and smooth the investor's overall tax burden. So by realizing losses in a disciplined way, investors can use those losses to offset current and future gains, reduce up to a limited amount of ordinary income each year, and carry any remaining losses forward indefinitely until they are fully used. So in that sense, properly harvested losses never leave, I'll use air quotes, leave the investor. They remain on the tax ledger as a long-term asset that can enhance after-tax returns over time when integrated thoughtfully into the overall portfolio and planning process. So again, moving to 2026 and beyond, all right, we have the assessment for rebalancing portfolios and tax loss harvesting as two essential checklist items that should be practiced, in my opinion, before the end of every year. Again, let's shift the focus to planning for the upcoming year. And these practices specifically focus on asset location, not asset allocation. And they stress incorporating proactive strategies that will drive greater tax efficiency for 2026 and beyond. So if possible, everyone should maximize contributions to tax advantaged accounts, your 401ks, your IRAs, or HSAs, and strategically locate tax inefficient assets such as taxable bonds and actively managed funds in tax deferred or tax exempt accounts to optimize overall portfolio returns. And then on the flip side, in taxable accounts, everyone should favor tax managed funds, low turnover index strategies, and stocks with long-term appreciation to minimize taxable distributions and enhance after-tax growth. And then lastly, before I wrap up my portion, and hand it back to Brian, I do want to give a quick plug for our investment team. Everyone, please keep an eye out for their 2026 economic and market outlook. I would expect the key themes of technological innovation and AI, a Federal Reserve inclined to ease, but closely monitoring the labor market and inflation picture, and ongoing macro and geopolitical developments, along with the fiscal and political backdrop ahead of midterm elections to remain central as we move into 2026. So with that, I will hand it back to Brian.
Thanks, David. I appreciate it, and I think that's a great call out. I think our next webinar in January is likely going to be our economic outlook, our 2026 outlook call with our investment team. So if you haven't received the invite, or if you don't receive the invite sort of by the early part of January, please reach out to your advisor. I think it's probably the most important webinar that we host throughout the year. I think it really sets the stage for the year to come and allows us to really sort of get in the right mindset at that start of the year. So great call out there, David.
Absolutely.
So we're about probably about 75% through our webinar here today, and I think the last thing that we want to focus on is retirement and cash flow planning. When I looked through some data recently, according to some retirement industry analysis, in 2025, this is a staggering fact. For the first time ever, more Americans turned 65 in a single year than any point in U.S. history, which is really hard to believe. It's a real milestone moment, and I think just highlights how important thoughtful income planning, flexible withdrawal strategies, and a disciplined cash flow management have really become. So John, maybe you can walk through, what should be our retirees or our soon-to-be retirees cash flow to-do list as we sort of close out 2025.
Sure. Thanks, Brian. So, really, we're close to the end now of 2025. So we really want to make sure that we go through that true checklist. So to close out 2025, I must remind everyone to take those required minimum distributions. You've benefited this year from letting your assets continue to grow, but there is a penalty if you do not take your RMD within the calendar year. So, think about where you'd like to send those dollars. So the best place might be replenish your cash account, reinvest in your after-tax brokerage account. You could, donate via a qualified charitable distribution. You could also have money to gift or purchase life insurance. It's a very versatile item, and if it's not going directly to cash flow. So more than happy to have some of those conversations. And, for those of you that are over 50 and you're still working, consider the catch-up provision that allows you to contribute an additional $7,500 to your 401k. So, you might be able to talk to HR, see if there's any additional funds you can get in there. And that's for a max of $31,000 this year. If you're between 60 and 63, they've introduced what they call the super catch-up, where you can now actually put in an additional $11,250 for a maximum of $34,750. And if you have a 403b or a traditional IRAs, you can get an additional $3,000 for the 403b or $1,000 for your IRAs. And, then it really kind of comes to, some of the more just kind of human elements, evaluate your year, think about the events that happened this year and your goals for next year, talk to your advisor about how things worked out against what you'd envisioned, and think about what David called asset location. Remember, asset allocation is what are my stocks, what are my bonds. Asset location is where are my stocks, where are my bonds, and your different types of accounts. These are the tools in your retirement toolbox that will help you fine tune your retirement income. This is something I feel very strongly about because we want to preserve these accounts so that you don't find yourself and you only have, that one type of account that's left. And, as we get ready for 2026, we want to start over with healthy balances and cash, just like last year. You want to make sure that you've got a good emergency fund, and an emergency fund is going to be able to allow you to not have to concentrate so much on the news and what's happening with the ups and downs in the market in the short term. Always think about how your income, whether it's a pension or Social Security, it lays the foundation for your year, and it's where we start when we're thinking about your baseline that we'll build upon as you live your life your way. As you distribute from your other assets, we want to create a balance that preserves the versatility of those assets. Like I said, with asset location, we want to think about, we don't want to exhaust that taxable brokerage account. We know that distributions from an IRA will be taxed at ordinary income, while your taxable brokerage account is taxed at tax advantaged capital gains rates. And then you have, cash and Roth that could be tax-free, along with HSA distributions for healthcare expenses. So we want to think about how we stack these things. And if we do it in a coordinated way, it really can just add a whole lot of balance, to your life and your expectations for the future. Now I'd like to kind of throw a shout out to the planning team. I highly recommend using our planning team. We love exploring these challenges and digging into these items. We know it's never just numbers. It's creating the best life possible, and that requires a lot of intention and attention. So, and that goes for all, once again, when it comes to people that might have a bigger, tax year or a unique situation. If you own your business, or you have concentrated positions within your firm and you're expected to exit the company and move to your next chapter, we have a deep bench of great people that are specialized and committed to your success. So, always make the call. We're happy to dig in and look at anything you have going on.
John, that's a great call out for our planning team, which obviously you're a part of, but I know Mark Bradford, the head of our planning group, has really pulled together, really great resources. And I think we reorganized this team this year to really be more helpful to our clients. So I echo the sentiments, John. Really use our planning team as much as you can. They are tremendous resources, and we're John and his team were really helpful in pulling this all together for this webinar today. So really can't speak highly enough about it. So let's pause there for a moment. It's about 12:30 right now. We'll start to sort of do some Q&A here. I don't see much queued up in the queue here, but I know we did get some questions ahead of time. So maybe we'll let folks on the call today, again, to hit the Q&A button, ask some questions in there. Again, just please at any point throughout this conversation, submit your Q&A within the screen here. We're going to let some of those queue up. Hopefully we get a few more in here. But we did have some ones that came in advance. So maybe John, David, maybe we'll start talking some of those Q&As. So the first question came from Teresa and Joseph asked two questions I think are somewhat related. Teresa said, I'm 58 years old and I have a husband who's 60. We max out our 401k every year. Should we do a Roth instead? We both work on our own company, which is an S Corp. And Joseph asked, at what point should we itemize versus taking the standard deduction, as we're retirees with income from Social Security and fixed monthly withdrawals from our investments? These are kind of tax related questions. Maybe maybe John, maybe you can touch on that. You talked a little bit about some of
Sure.
the tax stuff early on, but maybe you can, go a little deeper here with these two questions.
Yeah, sure. I think that the first question really kind of highlights what I was touching on at the end of the presentation. So, we want to make sure that you have different types of accounts so that when you're in retirement, every dollar doesn't have to be a pre-tax dollar that's going to increase your taxes. So I think that there's a short-term answer of, naturally, if you're a business owner and you want to continue to contribute, you can reduce your taxes by making a pre-tax contribution to a 401k. But we want to keep track of these balances over time. You may want to either open, or we want to look at the balance within your taxable brokerage account. And then we may want to create a Roth, because then, as I mentioned before with income, you're going to have any income, pension, Social Security, you're going to have your distributions from your retirement accounts. And then you really have a lot of maneuverability with your taxable brokerage account, HSA, Roth IRA, and cash, especially if, you find yourself and you have a big expense one year and you don't want that to be not only a big unexpected expense, but a fully taxable one. So I'd say that, the answer is really that we'd have to evaluate the different balances in those buckets. But, I generally am open to, making sure that you do have these other tools, even if there may have been a short-term, tax consequence. And, they also have a lot to do with health and longevity. And so when we're thinking about healthcare and taking Social Security, you really want to, these are things where sometimes I meet a lot of folks that want to delay Social Security as long as possible. But, we really do want to think about, our life expectancy, think about your loved ones and your own personal journey. And every year that you delay Social Security, the break-even point goes out into your 80s. So if your, health history doesn't have that, you may want to consider taking it earlier. And that can be a buffer for Medicare. And it also can be, an opportunity to kind of evaluate, does your wife have access to an HSA account? Can we fully fund that so you have that extra kind of gear? So once again, it's something that we want to evaluate, because we want to be able to provide you a couple of choices that you can make on your own. But I'd say that the big items that you are evaluating are, your longevity, the cost benefit of the time value of money of waiting versus taking those dollars now.
Yeah, and I think you hit on a pretty important part of this. It's really all personal, right? It's all individualized. I think every situation is going to be different. And I think it's really important to understand that and speak with your advisor for your specific situation, right, John? I think it's so important that we have those conversations, because I think we can learn a lot from reading on the internet and, reading books and articles and whatnot. It really comes down to the individual situation.
Yeah, if you put it in the context of, you want to write the best memoir and live the best life, you might not have to do what everybody else does. And so we can help you evaluate that and, make sure that, we're putting the quality of your life first before we're trying to meet, social norms.
Well said. Okay, so our next question is from Bruce, and his question's about investing for turbulence in retirement. Maybe we'll flip that over to you, David. Maybe you can talk a little bit about, that turbulence that naturally comes along with investing. Particularly, it feels like when you're in your retirement and you need those funds to last as long as they have to. So maybe you can talk a little bit about that, David.
Yeah, Brian, you kind of said it right there. I'm going to steal a line that I'll give a quick plug to our podcast as well, but I'm going to steal a line that our director of macroeconomic research just mentioned in a podcast. He said it to me earlier about a year or two ago, and kind of rings true. Volatility is the price of admission for compounding long-term returns. Like you said, volatility, turbulence is natural to investing. But there are some things that obviously an investor and a portfolio manager can do to alleviate some of the concerns on the portfolio volatility. Number one, as simple as diversification. There's the two counter arguments as far as there's a well-known saying, there's no free lunch meaning obviously, you must take the risk to earn the return, or you cannot get something for nothing. But then there's Harry Markowitz's, who's the father of modern portfolio theory, again, argued that diversification is the only free lunch in investing. So in practice, it really just means just making sure the portfolio is fully diversified across asset classes and really relying on portfolio managers to allocate to areas that they deem to be great opportunities, while also moving capital away from areas that are forecasted to be a little bit risky, but really all with the aim of, I would say, of kind of smoothing out returns for a total portfolio to help alleviate those emotional biases we're talking about towards volatility or turbulence. More on the portfolio side, you can incorporate differentiated strategies or alternatives, which are basically designed to target a specific level or pattern of returns, and that access different asset classes outside of just your stocks and bonds. So you can go that route. But I would say probably just as important, and maybe even more important, the portfolio needs to match the financial plan. So regardless of what happens to the markets, the investor can sleep at night, that they're going to be okay at the end of the day, and we can be opportunistic in the portfolios. But the investor has the ability to ride out the turbulence. Even more so, you really want to try to stress test that plan with your current allocation to confirm that across a range of market scenarios, both your portfolio and the investor's required cash flows kind of remain secure. So, we naturally get that question, but really kind of summarize, I think investors just need to be proactive in their portfolios if they're concerned about volatility and turbulence, especially in retirement, but ultimately be diversified and match the portfolio to your financial plan that, again, if it's implemented correctly, we feel will work in the long term.
Great. And, I think the free lunch analogy is a great one. So I do like that. It kind of hits home.
Yep.
Our next question here is from Bob. And, Bob says, I'm retired as of May of 2025. I'm on my wife's health insurance. Is there anything else I need to do? She will retire next year, I believe, and we're not taking any Social Security. I'm 65, 60, 64. I think it's a little bit sort of tied to what you talked about earlier, but maybe there's some other things that maybe we haven't touched on here, John.
Yeah, I think that really, you want to think about that transition. I think it really comes down to thinking about Social Security and Medicare as kind of a tandem. So you would really, want to get ahead of it so that about 3 months before your wife retires, you want to make sure that you're in Medicare and that you're scheduled for Social Security, because it can take a couple of months to kick in. And there are services. You can talk to your advisor, but there are specialists that can make sure that you select the right options in Medicare, and you may even stay on the same provider. And so that can allow that you have a real seamless experience. So it's not just, we've gone from my insurance to my wife's insurance to a new insurance, and you have that, that kind of choppiness in your, just the flow of your life. To be able to, to get on Medicare and stay with your insurer can help that a little bit. And with Social Security, part of it, a lot comes back to the tax, or the cash balance too. So like as David was mentioning, how do you deal with the volatility in the markets? Some of it is, not paying attention, to your account balance, just with those daily ebbs and flows. But if you have cash and you're taking cash out in large enough chunks, that also allows you to kind of take a step back and not have to worry about the volatility. So I'd say that, all of these items are a little bit tied together, but you want to definitely get ahead of qualifying for Medicare, and it might be a smoother transition if you take Social Security around the same time. But once again, talk to your advisor and make sure that we're not over or understating any tax consequences with income.
Okay. And if you didn't say it, John, I was going to say it. This is another reason to talk with your advisor. So those are all the pre-submitted questions. I did see one come through from Rocco, and I think kind of on the other end of the spectrum here. Rocco's a 20-year-old college student looking to break into sort of investing. And he's looking to sort of think about what starter investments can he allocate his money into? And again, this is probably a very, very broad question here, but maybe David, maybe you can whittle it down to a couple things that maybe Rocco can think about as he starts to get started in investing.
Yeah, I just actually did this with my youngest son, is 18 years old, who inquired as far as opening an account. So we did open an account for him. He deposited his own money into it. I did not do anything like that. My 24 and 25 or 23 and 24-year-olds are a little bit stubborn and thick-headed, so they haven't opened accounts yet. But to answer the question, pretty simple. You really want to go with low expense ratio index ETFs. You want broad market exposure. So, I recommended it to my youngest son to kind of split it between a US based and an international based. Again, kind of keeping that kind of theme as far as diversification. And again, it's been a long run for US over international as far as outperformance. This year it flipped. So again, you'll see that kind of obviously play out over time. But on both ends, you just want kind of broad market exposure with the lowest expense ratio as possible. And I highly, highly recommend, and I told my youngest son this as well, to keep contributing money to the account, whether you could do it monthly, quarterly, and just keep investing periodically. Because again, it'll alleviate some of the market timing aspect, whether the market goes up or down. And I think you'll obviously see the compounding of the account over time as you keep adding assets to it. So to directly answer the question with starter investments, again, broad index, broad market, US and international, with the largest portion of it US, low expense ratio index funds or ETFs. But again, kind of stressing too, just an investment strategy for a young adult, continue to place assets, capital into the account, because you'll see the long-term benefits over time as far as compounding the assets.
That second point you made there is a really good one. I too got some great advice from my folks when I was first starting out in the business world, particularly when it came to my retirement contributions. Right, I put those aside. Got the benefit of putting those aside, and again, as they've compounded substantially. But I never planned on those assets. So if I was making $10, $2 was going into those retirement plans, and I lived on $8. And I think thinking about living on the $8 as opposed to the $2, which is without the contributions, I really think helped me, like you said, have that forced savings that I will benefit from in later in life when I do retire, because the benefit of compounding, right? So I just think it's a great thing particularly for a 20-year-old college student really is trying to break into the investing world. So, John, any comments you have there as well, or that for Rocco?
Yeah. I mean, I think that's great. It really, the mindset of understanding that if you can save 15 to 20% of your income, you're a world-class saver. Knowing that, if you have the opportunity for an employer match, nothing beats a match. But also, I like to have diversification of different types of accounts too. So, try to utilize any 401k or anything that you might have access to. But in the short term, especially as you're starting out, your emergency fund will save you from your credit card, and your taxable brokerage account will work with your 401k to help you build wealth. So,
really
just have a couple different accounts and start from one to the next.
Great tips, and so well articulated. I think we should also commend Rocco, right? I think the fact that you're thinking about this as a 20-year-old is kudos to you, because I can tell you I didn't think about that as a 20-year-old, and I don't think John or I think David or John would agree, right? I think we're had we known then what we know now, I think we'd be in better shape. But I think it's really commendable that you're thinking about this already. So kudos
Absolutely.
to you. Keep up the good work.
Yeah.
Well, I think that's the last of our Q&A questions that have come up. I'll give it a couple more minutes here to let them line up here and see if we get any. I'm just checking our system here to make sure that I don't miss anybody. It doesn't look like I have. So why don't we sort of jump into some key takeaways here? I think this, as we summarize the webinar here. So let's talk about it. The key takeaways, and I think John and David really sort of hit this home. But first, on the tax planning side, I think we as what we all said is lock in deductions, manage your gains and losses, and confirm year-end tax moves. Right, finish 2025 with intention. Maximize the deductions. Have it harvest losses where appropriate. Review the capital gains and confirm withholding and estimated tax payments. Small adjustments now can meaningfully reduce your 2025 tax bill and position you even more favorably into 2026. If we look at the estate and charitable review, year end is really the best time to ensure your documents, your titling, and your beneficiary designations really reflect your goals. I think 2025 still offers powerful philanthropic opportunities. Again, coming on this quickly, but if you still have the ability to use a DAF, use it. Use your appreciated securities and make those strategic year-end gifts to support the causes that you care about, while really giving you the benefit of some tax efficiency there. From an investments perspective, I think volatility, concentration, and shifting leadership across the sectors really define 2025. Use the year-end to rebalance if it makes sense and diversify where needed. Harvest those gains or losses intentionally and make sure your portfolio is aligned with both current conditions and really the opportunities that David touched on emerging in 2026. And lastly, from a retirement and cash flow perspective, really, as I mentioned, a record new wave of retirees in 2026, in 2025 and into 26 really makes now the right time to review those RMDs. Confirm your cash flow needs, plan tax smart withdrawals, and update your retirement income strategy. Year end is the chance to make sure your plan supports your lifestyle today and really into the future. Bottom line, finish 2025 strong by acting with purpose now. Again, we've only got a couple more weeks left of the year. A thoughtful year-end review with your advisor across taxes, estate planning, investments, and retirement cash flow really helps you reduce surprises, capture opportunities, and really start the next year with clarity and momentum. So with that, I want to wrap up today's session. I want to thank you for spending the time you did with us today. If today's discussion sparked any questions or highlights any opportunities, we encourage you to schedule a one-on-one planning review with your Bryn Mawr Trust advisor. Before we kick off, I want to give a quick shout out. I did mention the economic overview. That's going to be our next webinar in January. But we're going to have a really exciting 2026 education series, and the event calendar is coming. That's going to cover markets, planning topics, and community events throughout the year. We hope that you're able to join us, and we'll see you on another webinar or another education series throughout the year. So on behalf of John, David, and the entire Bryn Mawr Trust team, happy holidays, best wishes for a healthy, joyful, and prosperous new year. We truly appreciate the trust you place in us, and have a great day. Thanks so much.
Thanks, everyone.
Take care.